does the data actually concur if America is headed for a recessive economy or simply a soft landing? Are we simply smoothing out economics? Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today, a macroeconomic journey. Yes, folks, we're going to dig into the Reserve of America, the Fed Reserve's rate cut. It's 0.5%. And of course, does that mean we've got fireworks ahead, or are the doomsdayers right? Should we find a rock to hide under and live the rest of our lives? We're going to discuss the rate cut because it is significant. It is a big lead indicator for what next in Australia. And of course, the US cash rate has been a lot higher than the Australian cash rate. So what does that mean for us here in Australia? So that's what we're going to dig into today. I'm boiling hot in my studio. Yes, summer is here early, and I tell you what, I'm sweating away, but let's do this. Let's rock the boat when it comes to understanding what next for Australia when it comes to interest rates and what we can learn from the US rate cut. But welcome back, regulars. Play the program in double speed. Get your life back. You know the drill. And of course, if it's your first time tuning into the program, play the program in double speed, get your life back. But we just had it. The trigger has been pulled. The gun has been shot. The rates have dropped in the biggest economy in the world. And of course, that can be seen as a trigger for a possible recession in America. But does the data actually concur if America is headed for a recessive economy or simply a soft landing? Are we simply smoothing out economics? Well, we can look at some past history to understand why American commentators talk about America potentially having a little bit of a recession, a little bit of a dip. There's a rule in economics known as the SARM rule, and effectively, if you have 3 quarters in a row of rising unemployment, it is usually followed, and in past history, it has been followed by a recession. In the United States, the SARM rule was invoked in the 1990s, in 2002, in the GFC in 2008 and 9, and of course, through COVID. So we are seeing actually the similar numbers of activity when it comes to unemployment rising in America. But certainly when you track the actual data using the SARM rule, we can see that, well, the rise in the jobless rate in America is fairly well moderate, if not low, compared to the era of 1990, 2008, and of course during the COVID era where a lot of people were laid off, and of course a lot of stimmies were thrown into the economy to help people through that 1 in 100 year situation. But what we can see is certainly unemployment has risen, and it has risen off probably the lowest base ever, 3.7% in America, to today an unemployment rate of 4.2%. So we can see that the Reserve Bank of America is willing to cut 0.5% when around 0.5% unemployment rise occurs. And so that's very, very interesting because you generally drop rates to do 2 things: stimulate activity, stimulate job growth, stimulate borrowing, and of course, if inflation is starting to go back into its box, you generally also look at dropping rates. Now, the interesting thing we can learn about America is they put rates up at a much larger level than what we have done here in Australia. In fact, most OECD countries have put rates past where Australia has put them at a cash rate of 4.35%. And a lot of that is to do with a higher inflation rate in other countries, but also the way that policy makers and the central banks of those countries have wanted to deal with inflation. They've been willing to push their cash rate a lot higher than we have here in Australia. And it does appear then they are coming out of those higher rate environment, obviously a lot faster than us, whereby we've taken a middle road approach of where our rates have sat. And of course, that ultimately may mean here in Australia, our rate cut cycle begins in 2025 because we just simply did not push the envelope when it comes to how high we have wanted to take rates. And of course, a lot of political grandstanding has been put and a lot of pressure put on making sure rates don't tip over too high and we don't tip the country over into a recessive economy. But obviously, if you drop rates too early, you run the risk of inflation coming back out of its bottle. And of course, it's fair to say that the Reserve Bank of America will be watching that very, very closely, that if this decision ultimately will lead to in a spike of spending and a spike of supply and demand side economics around inflation. If inflation starts to go back up, I think we will see a pause on further rate drops in the United States. If things seem to smooth itself out, well, we could see further rate cuts. And in the actual language of Jerome Powell, the governor of the Reserve Bank of the United States, or the Federal Reserve, the decision to cut interest rates is about normalizing monetary policy from restrictive levels to a non-urgent shift to basically the economy. So effectively what the Reserve Bank there is saying is things are normalizing, and as such, money should also be normalized, and it's time to go back to a new normal, a new moderate level of where the cash rate will sit. And if we look at basically the future US Fed estimate of a neutral cash rate, it sits at around 3%. Remember, it has got as high as 5 and a bit percent, and the estimate by 2026 is the cash rate there will drop to around 3%. And of course, that means something economically elsewhere. And of course, one could argue that you don't drop rates unless there's a crisis. But equally, I think we potentially have seen the inflation crisis peak. And of course, maybe it's about normalizing monetary policy. But certainly when it comes to the jobs market over in the US, there is not a lot of layoffs actually happening. It's actually about not creating new jobs. And so there is, in economic terms, a lot of employment hoarding happening in all economies. Basically, companies are not making a hell of a lot of money, but they are reluctant to lay off their team because they've invested so much money in their team that they're trying to carry them through to this smoother economic soft landing. And obviously that comes with a little bit of a risk for businesses, but the main thing is businesses are action ready when things start to normalize a bit more. And of course, to train and reskill and retool is expensive in itself. And today, with a skill shortage in various different sectors, it's very common for basically employment hoarding to happen, whereby companies are not productive, but they're actually keeping a lot of their workforce for a new push down the track. And I can certainly say that in my own company. Like, it's not highly profitable at the moment, but, do we want to, basically, terminate roles? Well, the answer is no. We want to see it out, grind it out, hunker down together, and come out of this part of the economic section of the economy in good shape for better times. And that's just the nature of business, making those business decisions. So there's a few broad reasons why the global economy will be likely to continue to tread water and basically not go into a global level recession. A lot of it is to do with many households across the globe in pretty well decent shape in OECD countries. Obviously, they're a little bit spend reluctant, but for the most part, household structures are holding it together through this level of inflation. If inflation was to creep back out and interest rates, for example, in the US start to go back up, then I think you have to say economically, households will start to do it very, very tough. I guess from a fiscal policy set of standards around the world, most governments are playing it reasonably safe. They realize that if you go out and spend more, it's going to add a lot of challenges to the economy. If the Reserve Bank's trying to keep inflation under control and fiscal policy is to spend and spend and spend, it can almost create more fuel on the flames. So it is fair to say fiscal policy is fairly neutral around the world. You're seeing a pretty, stock standard level of spending. And of course, the policy makers, the politicians are really letting monetary policy do its thing. And I think obviously if rates come down, that monetary policy will be the boost for the economy. And obviously there's a lot of geopolitical risks that will continue to linger. And I think for a lot of the people inside marketplaces, they're just learning to deal with what that looks like. So when it comes to obviously Australia's interest rate, there's always an economic outlook, and that involves understanding financial conditions, the labour market, here in Australia, what our population turnover looks like. And of course, probably the biggest challenge here in Australia is supplying affordable housing to the marketplace, which seems to be terribly difficult. We are at the lowest levels of affordability ever in Australia's history, and that's a combination of high house prices and high interest rates. But the Australian property market seems to continue to kind of bubble along. But of course, in America, to reach a soft landing, if we go back and understand how soft landings have been met in the past, in modern times, it's usually around a 75 basis point cut to even up to 2 percentage points cuts. But if you were cutting by 2 percentage points, there's probably something, that your economy it needs a lot of stimulation. And so it is believed that most economies will cut by 75% to 2 basis points. So here in Australia, remember, we have not gone as high and as hard as the rest of the world. So the cash rate in America could come down by 2%, but that would equal Australia basically dropping the cash rate by basically 1%. So we just have to take that into consideration into what next here for Australian interest rates. Now, remember, an economy can go in 6 different directions. You can end up in stagflation, basically stagnant GDP growth, but high inflation. You can end up in a recession, which is basically backwards GDP growth and a moderate level of inflation. You can end up in a controlled, stabilized balance sheet recession, basically a technical recession where GDP drops and goes backwards and inflation comes down to a really good level. And of course, the soft landing, which everyone wants, is GDP growth really anywhere from above 0 to 2% and inflation at 2%. It's like the 2 and 2 rule. And of course, the challenge with dropping rates is you can miss the soft landing and either end up in a recession, a controlled stabilization, balance sheet recession, or you can go to reinflation. Reinflation, of course, is where the inflation rate starts to go back up. And of course, the GDP starts to really soar again, and you start to get this inflation of like obviously the economy, but also the inflation rate. And so it's a bit of a monetary jigsaw puzzle at times, but where many economists start to see right now is really the scenario of a normalization, a soft landing. And this will be an economic marvel if we end up in a soft landing. And, certainly I would have predicted that the unemployment rate was a lot higher. I would have predicted that, there was a different reaction from the business community. But I think here in Australia, it's so tough to get talent that everyone's holding on to talent and just grinding out the situation. So that's really good news for obviously everyone in the workforce, that we haven't sort of seen these massive swings in unemployment. But if we look at Australia's GDP growth, we can see that it is going to drop now between basically present day and probably about 12 months. We're going to see very lackluster GDP growth, circa 1%. And obviously that is also going to mean companies are not growing, and an eventual raise of the jobless rate. Now, jobless figures just came out last month, and the jobless rate has remained the same at around 4.2% here in Australia. Remember, the American economy is also at 4.2%, but they've got a higher interest rate than Australia, which technically means they've got the ability to continue to drop rates before Australia actually even plays that game. So Australia's unemployment rate basically needs to reach around 4.5%. And then you will see a correlation of potential rate cuts. And again, the jobs market's still very strong here in Australia. even though we're also coming off a very low base in the jobless space. We need to shred more jobs in the economy for interest rates to come down. And really, the cash rate dropping is just a game of bottling inflation and also equalizing and smoothing out the unemployment rate. Now, I mean, typically unemployment rates have sat at 5 to 6% in Australia. So having an unemployment rate peak at, say, 4.5%, then rates dropping, it's ridiculously low when you look at the long-term average. The unemployment rate is still ridiculously low. And what's interesting is actually if we look at GDP growth in 2026, according to a lot of forecasts, economic forecasts, is the country starts to really grow again in 2026. And we will see again the jobless rate drop again below 4.5%. And we will see effectively in 2026 the cash rate find its balancing point. And that balancing point is suggested to be about sort of 3 to 3.5%. Obviously, around 1% lower than where we are today. And of course, that means you'll be borrowing money at a lot less into the future, which will help with the biggest problem Australia has in its economy is the affordability issue around housing. It's unproductive because people can only put a large amount of their wage into housing and can't spend it in other spaces, innovate and create production elsewhere. We're at 35% of income at the moment going into housing, and that's an all-time high across Australia. So interesting. I think very, very interesting. Will we end up with stagflation, more inflation, a recession, a reinflated economy, or a soft landing? Odds are, I think we're probably actually on par for a soft landing. Household seems to be under control. There's not rampant unemployment, and really fiscal policies at a government level and at a business level are broadly neutral. Just see this thing out, grind it out, and see what happens next. Obviously, this stuff can change when economic news is brought to the surface, but ultimately the Reserve Bank drop in America is going to eventually be replicated here in Australia. And if we look when that replication begins, according to my Oxford Economics charts, you will see that midway through 2025. Could those charts be wrong and a rate cut happen this year? It's possible, but I think we have to say we've still got to get inflation down a little bit. The unemployment rate seems to be, the economy seems to be doing too well in a way to validate a reason to drop rates. And that you can see the economy doing well with just the amount of jobs that were put on last month. Something like 42,000 jobs were created last month alone in the Australian economy. And of course, this is very, very interesting. But it will actually be interesting to watch America because the fact that they're a leading cash rate marketplace compared to us, we will be able to see what that looks like for their property market. We'll be able to see basically what is happening elsewhere before we get our chance here in Australia. And we've also seen a little bit of this in New Zealand. New Zealand recently dropped their cash rate, again, a lot higher than Australia. Australia's cash rate went down the medium path, not the high path. America and New Zealand went over 5% with their cash rate. And in New Zealand, the news of their first drop has certainly seen a lot more appetite for the housing market in New Zealand. So certainly we know that when rates drop, buyers come back out and shop in the real estate world. Usually the only thing stopping them is a high unemployment rate. So what we can see from the data is that's not going to happen. There's not going to be a high unemployment rate. And of course, our supply figures are woeful. And of course, if the cash rate drops, you've got low levels of supply, a cheaper cost of finance, and effectively a low unemployment rate, which will probably lead to more accelerated wage growth. And of course, as long as inflation doesn't come back out of its bottle, we will achieve that smooth landing. The beautiful thing about the US going first as a major economy, we get to see whether inflation spikes back up over there, and we can probably make monetary policy here to comprehend what is happening there. Obviously, they are two different economies with two different macroeconomic drivers, but ultimately, we could almost argue the US is a lead indicator and Australia's a lagging behind, and we can make some decisions on what next by simply studying what happens to the US over the next 3 to 4 months. If I was the Reserve Bank of Australia, I would be watching what is happening in America for the next 3 to 4 months, and then I will know more about my next move on policy decision making here. But yeah, all right, folks, that's the news. The Reserve Bank of America cuts rates, and there is no fireworks, and there is no rock to hide under. So I'd probably ignore the doomsdayers. It does seem like we're smoothing out. All right, folks, thanks for your time. Talk soon. Thanks for tuning in to the Urban Property Investor. To never miss an episode, make sure you subscribe to the podcast on your favorite app or on YouTube. And I would love it if you could give the show a rating and share it with your friends and family. In between episodes, you can always keep in touch with me by connecting on social media over Facebook, Instagram, or LinkedIn. Until we meet again on the next episode of the Urban Property Investor, take care and bye for now.